Hello, welcome to our second quarter investor briefing. My name is Chris Caparelli. With me on the line is my partner, Lindsay Payne. And we're here just to give you a quick rundown of the capital markets through the second quarter and a quick refresher on the Greater Milwaukee Foundation portfolio. Marquette is still relatively new to the Greater Milwaukee Foundation. We've been lucky enough to work with you for about the past year or so. So just a quick reminder of who we are on this slide. And with that, we'll let Lindsay spend a couple minutes talking through the capital markets.
Sounds good. So looking at this slide, you'll see returns across the major asset classes for both the second quarter and year to date. The top group represents U.S. equities, followed by non-U.S. equity markets, and then rounding things out with fixed income at the bottom. The key takeaway from the second quarter is that most risk assets moved higher. U.S. small caps and emerging markets were the stars of the show as the market broadened beyond the Magnificent Seven, seeking opportunities in areas with stronger valuations, improving earnings expectations, and exposure to capital expenditure around the AI infrastructure. Despite increasing geopolitical uncertainty with the conflict in Iran and the closing of the Strait of Hormuz, markets really rallied around resilient corporate earnings. Most companies beat their earnings expectations, and the consensus is that we should see this continue into the third quarter. That said, July was a bit more muted. We saw traditional stocks and bonds pull back a little bit as energy prices rebounded and yields rose. Inflation remains a key focus, and while it's still above the Fed's target of 2%, prices do appear to be cooling. So that's pretty much taken a rate hike off the table at the September meeting. As we move through the rest of the third quarter, a lot will hinge on the path of inflation, midterm elections, and whether these corporate earnings can continue to support their current valuations.
Thank you, Lindsay. And then I will spend just a couple minutes reminding you all what's gone on over the last few years. So it's been a year of transition. We've been busy working to upgrade things like portfolio liquidity, increase portfolio efficiency, reduce fees in the portfolio, and really focus on asset allocation to drive long-term results. I wanted to say a quick thank you to the investment committee and the staff of the Greater Milwaukee Foundation. It's been a busy year. There have been a lot of moving parts coming and going over the last 9 months or so since we've been up and running. We've transitioned about 17 managers out of the portfolio, which translates to roughly half of the overall assets that have turned over. Getting some new strategies and new managers in line to drive that forward performance. While on the topic of performance, Lindsay, thank you. It's been a choppy year here in 2026, but it's been a pretty good year when we zoom out. And certainly as we look over the long term, 7, 10, 15 years, portfolio results have been consistently above the long-term target return. It's been a good decade despite all that we've gone through over that time frame. The relative results we think are a little bit behind the benchmark. We are really focused on improving those numbers, getting them back above the long-term targets. And just, wanted to remind everybody that the Greater Milwaukee Foundation has been a really good place to invest capital and compound capital over a long period of time. You look at 10 years and 15-year results, they've been exceptionally strong compared to peers. And our goal is to continue that track record well into the future. So with that, just wanted to say thank you for joining us, for listening in, and we look forward to keeping you up to date as we move forward through the rest of the year.